Welcome to the deep dive. I'm really glad you've joined us today because we're plunging into a topic that's not just making headlines. It's quite literally reshaping our world, our wallets too, and even the way we think. I mean, just think about your own day. When was the last time you used, say, a chat bot for customer service, or maybe saw an image online that made you stop and wonder, hang on, is that AI generated? And
hmm
it really feels like artificial intelligence is suddenly everywhere, just woven into the fabric of our daily lives, often without us even realizing it. But how much do we really understand about its unfolding impact, its complex, sometimes really surprising impact? So this deep dive is all about artificial intelligence. Our mission today, it's to pull back the curtain on AI's rapid integration into our lives. We're going to explore, well, pretty much everything from its dizzying effects on investment portfolios, where fortunes are being made and lost, right, to its subtle, yet I think profound influence on our cognitive processes, how it might be reshaping our brains and our very perception of truth. And of course, we have to tackle one of the most talked about aspects, AI's impact on the nature of work itself. This is tech that for so many years felt like it was straight out of science fiction, right? But it's here, it's now, and it's moving at just an astonishing speed.
Absolutely. And to help us navigate this incredibly intricate, fast-moving landscape, we've meticulously pulled together a really robust stack of sources for you. We've got comprehensive financial analyses from major investment firms. These really dissect the performance and the projections of key AI stocks. That gives us a crucial, data-driven look at where the money is truly flowing. But also, importantly, where astute caution is being advised by people on Wall Street. And beyond the financials, we'll be drawing deep insights from recent academic studies on AI's cognitive and societal impacts, exploring how this technology might be subtly rewiring our minds, maybe even challenging our fundamental perceptions of truth in this, increasingly digital world. And finally, we've gathered real-world examples, detailed reports on AI's unfolding effect on the job market, and the strategic shifts happening within major corporations. So these diverse sources, economic data, psychological research, real-world case studies, they offer a truly multifaceted, balanced perspective on where AI stands today and where it might be headed in the immediate future.
That's precisely right. And our mission for you, our listener, is to try and cut through all the noise, all the hype, and sometimes, let's be honest, the fear. We're going to extract the most important nuggets of knowledge, uncover some surprising facts you might not have encountered elsewhere, and share critical insights to help you feel genuinely well informed about AI's complex reality. And as always, we're committed to maintaining a balanced, neutral approach, even when we encounter conflicting viewpoints or, highly charged discussions. So yeah, prepare for a fascinating journey into the heart of the AI revolution. Let's really dive in.
Okay, let's begin by looking at the dizzying heights of the AI boom, particularly in the stock market. You've probably seen the headlines, heard the breathless chatter there. There's been just tremendous excitement around artificial intelligence, and it's certainly reflected in market performance. We've seen some truly eye-popping gains, almost defy belief, really. For instance, Palantir Technology is a name that's probably familiar to many of you listening. Its shares have advanced a staggering 2,700% since January of 2023. Can you even wrap your head around that?
2,700%. And it's not an isolated case. Supermicrocomputer shares, they've advanced 470% in that same period, signaling what many are undeniably calling an artificial intelligence boom. It's clear the stock market's been hitting record highs, and a huge part of that momentum is thanks to tech giants. Companies like NVIDIA, Alphabet, Google's parent company, Meta, Microsoft, all of whom are making enormous multi-billion-dollar investments in AI-related products and infrastructure. It truly feels like everyone, from institutional investors to individual traders, just wants a piece of this rapidly expanding AI pie.
That's certainly the outward appearance, isn't it? A picture of just unbridled optimism, seemingly endless growth. However, what's truly fascinating here, and what our sources consistently highlight, is this core tension. It emerges when you look beyond those, eye-popping headlines and really dig into the underlying fundamentals. Despite this tremendous market boom, some select Wall Street analysts are advising a distinct note of caution. In some cases, they're even going as far as advocating selling some of these incredibly popular AI stocks, suggesting they're dangerously overvalued. And this raises a critical question for us and for you as a listener. Why the disconnect? Why are some highly respected professional analysts seeing such potential downside when the broader market seems to be just soaring on AI enthusiasm? It really highlights the inherent difference between raw market sentiment, which, let's face it, can be driven by hype and speculation bleak, and fundamental valuation, which tries to gauge a company's true worth based on its earnings, its assets, its future prospects. Let's dig into a couple of specific examples just to illustrate this tension. Let's start with Palantir Technologies, traded on the Nasdaq as PLTR. Palantir develops these sophisticated data analytics and AI platforms. Their primary clients. They span both commercial enterprises and various government sectors, defense, intelligence, healthcare, you name it. The core of their software is designed to help clients take incredibly complex, often disparate data that might otherwise be overwhelming or just indecipherable, and transform it into actionable insights, real, usable information. Beyond just analysis, their platforms also allow clients to effectively train and deploy machine learning models that ultimately drive better, more informed decision-making over time. We're talking about incredibly diverse use cases here, stretching from optimizing supply chains in retail and manufacturing to bolstering national defense strategies, enhancing financial crime prevention. It's broad. In fact, Palantir has garnered significant recognition as a market leader. International Data Corporation, IDC, ranked them as a top player in decision intelligence software, and Forrester Research acknowledged them as a technology leader in AML platforms. And given that the broader data analytics software market itself is projected to grow at a robust 28% annually through 2030, according to Grandview Research, well, Palantir appears to be positioned quite favorably within this expansive and critical landscape. Now, looking at their recent financial performance, Palantir recently reported exceptional second quarter results. They actually beat estimates on both the top and bottom lines, which is always good news. Their customer base saw a significant increase, 43%, growing to 849 customers. Even more impressively, existing customers deepened their engagement, increasing their spending by an average of 28%. This led to a substantial 48% climb in overall revenue, hitting $1 billion. And notably, this marks their 8th straight acceleration in revenue growth. That's quite a feat for any company. And on the profitability front, non-GAAP earnings saw a robust 77% increase, reaching some 16 cents per diluted share. So, by all fundamental accounts, these are very strong growth numbers, indicative of a thriving business, wouldn't you say?
Those numbers sound fantastic, truly, indicative of a company performing extremely well. So what's the catch then? Why would an analyst look at that kind of growth, those numbers, and still say sell? What is it about the valuation that makes it so concerning, even with such impressive performance?
Well, that's where the analyst's bearish view truly comes into sharp focus. Richie Jaluria, an analyst at RBC Capital, has assigned a very aggressive sell rating on Palantir, with a target price of $45 per share. Now, this target implies a potential 75% downside from its current trading price, which is hovering around $182. That's a huge potential drop. And the primary overriding reason cited for this aggressive sell rating is what Jaluria terms an unsustainable valuation. And this is the absolute crux of the argument against Palantir from this perspective. To really understand what unsustainable valuation means in this context, let's look at the numbers. Palantir currently trades at an absurdly rich 133 times sales. Now, to put that into perspective, because 133 times sales might sound a bit abstract, this sales multiple isn't just a number. It tells you how much investors are willing to pay for each dollar of revenue a company generates. At 133 times sales, the market is pricing in truly astronomical, almost impossible growth for Palantir far into the future, a growth trajectory that just dwarfs even other high-flying tech giants. Consider its peer, NVIDIA. Widely considered expensive, right?
Trading at a premium due to its AI leadership. NVIDIA, the next most expensive stock in the S&P 500 by this metric, trades at 30 times sales.
Wow, 30 versus 133. That's a massive difference.
Exactly. A massive, stark difference. It illustrates just how much more speculative the bet on Palantir currently is. What this suggests is that even if Palantir's share price were to drop a dramatic 77%, which would mean a substantial loss for current investors, it would still be the most expensive stock in the S&P 500 based on its sales multiple.
Still the most expensive, even after a 77% drop.
That's what the numbers imply. It highlights an extreme premium placed on the stock, even compared to other highly valued high-growth tech companies. And it's not just a single analyst thinking this. When you look at the broader analyst consensus on Wall Street, they collectively see Palantir as significantly overvalued. Their average target price is around $151 per share, implying about 17% downside from its current price. Now, of course, individual analyst forecasts should always be considered with a grain of salt, But a widespread consensus like this does suggest a significant portion of the professional investment community believes the stock is currently overpriced relative to its current fundamentals and, perhaps more importantly, its realistic future growth prospects. Okay, moving on to our second case study, Supermicro Computer, or Supermicro, trading as SMCI. Supermicro is a company that designs and manufactures high-performance storage systems, compute subsystems, servers, that kind of hardware. They specialize in building full server racks that are tailor-made for specific demanding applications. particularly for artificial intelligence and other high-performance computing tasks like data centers, cloud computing, enterprise IT. What made them an early leader, kind of a breakout star in the AI server space, was their remarkable ability to quickly bring new chips to market. A rapid time to market that initially provided a significant competitive advantage in a fast-evolving hardware landscape. Their unique strategy revolves around using electronic building blocks across their product lines. This modular approach allows them to quickly assemble a broad range of servers, enabling them to rapidly release hardware that incorporates the very latest technologies from key chip suppliers like NVIDIA and AMD. In fact, their CEO, Charles Liang, has claimed that Supermicro can often bring new AI chips to market 2 to 6 months before its competitors. And this agility has been crucial in the intensely competitive and fast-paced AI hardware market, allowing them to capitalize on early demand.
Okay, so if they're so nimble and quick to market, that sounds like a huge advantage, right? Especially in AI where speed is absolutely everything. Why is Supermicro then also facing a sell rating? What's eroding their early lead? And why are analysts cautious about their future despite this apparent agility?
Right, that's the crux of the Supermicro story. While their time-to-market advantage is certainly significant, our sources point out something important. It doesn't necessarily constitute what's called a durable competitive moat.
A durable competitive moat. Explain that for us.
Sure. For you, our listener, a durable competitive moat refers to a sustainable competitive advantage. Think strong patents, deeply entrenched brand loyalty, powerful network effects, something that effectively protects a company from direct competition over the long term. Supermicro's speed, while impressive, isn't as durable as, say, NVIDIA's ecosystem lock-in with its CUDA platform, or maybe Intel's sheer scale in chip manufacturing. And what we're seeing now is that Supermicro has indeed started to lose momentum as competition has intensified dramatically. Dell Technologies, for instance, is cited as a major competitor now aggressively vying for this exact same high-growth server space.
Ah, Dell. Okay.
And this increased competition, it's clearly reflected in their recent financial results. The company announced what were widely described as dismal financial results for the June quarter. Revenue increased only a modest 7% to $5.8 billion. That's a far cry from the explosive growth seen in other AI-related hardware. Furthermore, their gross margin, that's the profit they make on each sale before operating expenses, it narrowed by 70 basis points to 9.5%. Yeah. And on the bottom line, GAAP earnings actually fell by 33% to $2.31 per diluted share. The margin pressure in particular is a glaring concern. Last year, management had optimistically forecast that gross margins would normalize around a healthier 14% to 17% by the end of fiscal year 2025. Yet, contrary to their expectations, margins have continued to contract, which is a clear and direct sign that Supermicro is losing pricing power.
Meaning they can't charge as much because of competition.
Exactly. They're being forced to accept lower profit margins as the AI server space becomes increasingly competitive and other players enter the market. Adding to these concerns, the company has slashed its revenue guidance significantly, reducing it to $33 billion from a previous forecast of $40 billion for the fiscal year ending in June 2026.
That's a big cut.
It is. A substantial downward revision like that often signals underlying operational issues, increased competitive headwinds, or just a less optimistic outlook on future demand. Furthermore, Supermicro has a history of underperformance relative to analyst expectations. Wall Street has historically overestimated the company's ability to meet its targets, with Supermicro missing consensus earnings estimates by an average of 13% over the last 4 quarters. This pattern suggests a recurring challenge in meeting financial projections. Now, while the long-term outlook for AI server sales remains incredibly strong, projections of 38% annual growth to reach a staggering $850 billion by 2030 year week, Supermicro's earnings are expected to grow less quickly than the market itself, primarily because, as we said, it lacks that deeply rooted, durable competitive moat. Wall Street analysts project the company's adjusted earnings to increase at a slower rate, maybe 28% annually, through the fiscal year ending in June 2027. So, while its current valuation of 23 times adjusted earnings might still look reasonable compared to forward earnings estimates,
its consistent misses on consensus earnings estimates suggest investors should indeed be cautious. The conclusion drawn from these analyses: while shares might not necessarily plunge the full 49% implied by Goldman Sachs' more aggressive sell rating, there are likely better places for investors to put their money if they're seeking AI exposure with more defensible long-term growth.
Okay, that makes the picture much clearer, much more complex. So what does this all mean for you, our listener, when you're looking at the AI market, whether you're an active investor or just trying to understand these economic currents? We've certainly seen incredible, almost unbelievable growth in the stock prices of companies riding the AI wave, generating immense wealth for some. We've also just heard significant, well-reasoned warnings from analysts about potential overvaluation and intensifying competitive pressures. Palantir, seen as fundamentally sound, a leader in its space, but by many metrics just ridiculously expensive, trading at valuations that demand nearly impossible future growth. Supermicro, on the other hand, is facing margin compression, increased competition that might erode its early lead in a booming sector. It presents a real conundrum for anyone trying to navigate this space, doesn't it? Is the market's collective enthusiasm getting ahead of itself, valuing these companies purely on future potential that may or may not materialize at the projected scale? Or are these just individual analyst opinions, perhaps too conservative in what truly is a transformative technological moment? It's crucial to remember, I think, that investor confidence in any individual analyst's forecast should always be tempered with broader market understanding and, critically, your own independent research. It's a dynamic, volatile, and deeply fascinating space, to say the least.
Right. Having explored the market's enthusiasm and the financial caution surrounding AI, I want to pivot now to a really intriguing and perhaps even more profound question. What is AI doing to our minds? Here's where it gets really interesting, I think. We're transitioning from financial markets and investment talk to something far more personal, maybe even more fundamental. The unseen impact, the subtle ways AI might be reshaping our cognitive processes. Think about a concept we've maybe touched on before, cognitive offloading. This refers to our increasing reliance on technology to ease mental effort. A simple example, how many phone numbers do you remember by heart now compared to before smartphones?
Oh, very few. Maybe one or two.
Exactly. Our devices store them for us, making it seem unnecessary to retain those details. It's a form of digital amnesia, where our ability to remember information stored on devices declines. And AI, with its immense processing power, its incredible ability to summarize vast amounts of information, even generate text, it excels at supporting this kind of cognitive offloading. It promises unparalleled convenience and efficiency, sure, but what's the potential cost to our innate intelligence, our capacity for deep thought?
That's a crucial question, and it takes us directly to a critical concern about the future of critical thinking itself. A recent study, specifically designed to explore this very phenomenon, provides some compelling insights. It meticulously analyzed 666 participants across a wide range of ages, educational backgrounds, experience levels with AI tools. It was comprehensive. It combined quantitative questionnaires yielding numerical scores for critical thinking with in-depth, open-ended interviews that captured more nuanced qualitative data. And the core finding was quite telling. The study found a direct measurable link between increased AI tool use and a decline in critical thinking skills. And the researchers defined critical thinking quite precisely as the ability to analyze, evaluate, and synthesize information to make informed decisions. In other words, the more participants reported relying on AI tools for tasks that typically require mental effort, the lower their critical thinking scores tended to be. What's particularly significant, and maybe more concerning, is the impact on youth. This negative correlation, the link between AI use and declining critical thinking, was found to be more pronounced among young people, specifically those aged 17 to 25.
Really, that specific age group?
Yes. This group, as you might expect, tends to adopt and rely more heavily on AI tools. And the study strongly suggests this pervasive reliance directly impacts their developing cognitive abilities. Older adults, on the other hand, appeared to have some protection from this erosion, likely because they've already spent years cultivating their own cognitive skills, exercising independent thought, engaging in complex problem-solving before AI became so prevalent and easily accessible.
Like a kind of cognitive resilience built up over time.
Exactly. It suggests a foundational difference in how different age groups might be affected. Furthermore, in the interviews conducted as part of the study, some participants explicitly reported a diminished sense of self-efficacy, a feeling that they were less capable, less confident, or less effective when trying to complete tasks or solve problems on their own without AI assistance. So this isn't just about what AI can do for us, but what it might be subtly preventing us from doing for ourselves, and how that impacts our sense of intellectual independence.
That's a truly profound and honestly somewhat chilling concern, isn't it? If our critical thinking skills are diminishing, that immediately connects to an even broader, deeply troubling societal issue. AI's potential to make it incredibly difficult to discern what is true from what is fabricated. It strikes me that AI, by its very nature, is a probabilistic system. It generates the most likely next word or image based on its training data, not necessarily the truth. So, if we rely on it without that critical filter, how do we navigate a world where reality itself feels increasingly malleable?
Exactly. And this is where we need to understand AI's incredible strengths in information processing, but also its critical inherent weaknesses. AI has an unparalleled ability to process vast amounts of information on a scale no human can match. When you ask it a question, it's kind of like instantly entering that question into a search engine, then reading every single result from countless sources and summarizing the findings at lightning speed.
Which is amazing in a way.
It is amazing. No human could possibly do that with the same speed, efficiency, or breadth. It has access to massive pools of online data it's been trained on, far beyond any individual human's capacity. However, this contrasts sharply with our uniquely human cognitive skills. What humans can do, and what AI currently cannot, is filter, interpret, and truly evaluate information in a nuanced, critical way. We could distinguish between relevant and irrelevant, between useful answers and pure nonsense, because we apply context, reason, and our own lived experience. This leads us to a fascinating and maybe somewhat alarming academic experiment, conducted by a U.S. undergraduate professor, highlighting this distinction perfectly. This professor instructed students to use AI for a specific writing assignment, and then, crucially, to critically evaluate the results. To everyone's surprise, every single paper submitted contained what the professor described as bizarre information, fabricated sources, and fake quotes.
Every single one.
Every single one. The students themselves were reportedly shocked by this misleading content, realizing how easily AI could generate plausible-sounding but entirely false information. In the discussion that followed, they voiced serious concerns about AI's fundamental inability to think critically, to discern truth from plausible falsehood. One student's observation from this experiment was particularly poignant and thought-provoking. It truly encapsulates the dilemma we face. They stated, quote, "AI both knew more than us but is dumber than we are since it cannot think critically. Quote, I'm not worried about AI getting to where we are now. I'm much more worried about the possibility of us reverting to where AI is." Wow, that really hits home, doesn't it? It does. It raises an incredibly important and urgent question about the delicate balance here between leveraging AI's undeniable benefits at speed, its data processing power, and preserving, indeed cultivating, our uniquely human cognitive skills, critical thinking, nuanced reasoning, independent judgment. If we offload every mentally demanding task, if we let AI be our sole filter for information, do we risk losing the very capacities that allow us to truly understand and navigate the world, and by extension, effectively guide AI itself?
That student's observation really frames the challenge beautifully. AI's intelligence is just fundamentally different from ours. Building on this idea of how we perceive AI, there's fascinating research by Bing-King Lee, an assistant professor of marketing at the University of Missouri. This research explores how people's perception of AI specifically, whether they view it as a mere tool that assists them or as an agent capable of acting on its own, profoundly predicts their willingness to accept and integrate it into their lives. This study employs what's called a dual perspective lens, which essentially synthesizes our understanding of human acceptance of AI by looking at both these views. The study, which impressively looked at nearly 120,000 participants, found that certain AI features significantly impact this acceptance. Features like its capability, how well it performs tasks, its transparency, how understandable its workings are, which is critical for trust,
Well, it's
right?
truly critical.
Its perceived role. Is it a helper or a decision maker? The scope of its expertise, is it narrow or broad? And even its anthropomorphism, how human-like it appears or acts. What this research emphasizes is that as AI becomes more autonomous, more capable of making independent decisions and interacting socially, understanding this fundamental perception, whether we see it as an inanimate tool or a semi-autonomous agent, becomes absolutely crucial. Crucial for its effective, ethical, and widely accepted design and deployment. It shifts the conversation from just what AI does to how we relate to it and what we expect from it.
And this brings us to that common, almost existential question that often arises with powerful new tech. Is artificial intelligence good or bad? The perspective offered by our sources, which aligns with much technological analysis, is that like many transformative technologies, AI doesn't come with built-in moral judgment. It's neither inherently good nor bad.
The tool itself is neutral.
Exactly. The technology itself is, in essence, a neutral force, a powerful capability. What truly matters and what ultimately determines its impact on society and on us as individuals is how we use it and to what end is ultimately up to us. This means the responsibility for AI's ethical and societal implications rests squarely on human shoulders. We collectively decide its purpose and its application. The key takeaway here, I think, is that AI is designed and should complement and support natural intelligence, not replace it entirely. The real challenge before us lies in learning how to integrate the two wisely and effectively. This means consciously avoiding the trap of offloading every mentally demanding task to the machine, which could, as we discussed, diminish our own cognitive abilities. We need to strike a balance where AI augments our capabilities, making us more efficient, more informed, maybe even more creative, without diminishing the essential human capacities for critical thought, nuanced judgment, and independent reasoning. It's about leveraging its immense power without losing our own intellectual autonomy.
That's a powerful distinction, complement, not replace. Okay, let's pivot now to perhaps the most emotional, widely discussed aspect of AI's impact: jobs. There's widespread concern, a palpable fear about jobs that could be cut with people replaced by AI.
Mhm.
You hear the anecdotes, the predictions, the worry about what this technology means for livelihoods, for careers across countless industries. But what does the current data actually say? A thorough review of employment surveys, in-depth discussions with labor market analysts, recent company earnings reports. It reveals something perhaps surprising, certainly counterintuitive to the popular narrative. There is little evidence so far that would support assertions of a widespread economic impact from AI's growing usage on jobs. In other words, despite all the hype and fear, the big wave of AI-driven job displacement hasn't quite materialized yet in the broad economic data. Martha Gimbel, executive director and co-founder of the Budget Lab at Yale University and a former economic advisor to President Biden, puts it quite succinctly. She says it's such an emotional thing for people, many of whom are determined to see it in the data, and it's just not there yet. This suggests a significant gap between public perception and the current economic reality reflected in labor statistics.
Right. And that gap between perception and reality, as our sources explain, can be partly attributed to corporate incentives and a shifting narrative. What's fascinating here is why companies might hype AI's potential as a disruptive force. The stock market, as we discussed, has been hitting record highs, largely fueled by enormous investments from tech giants into AI. This creates a powerful, almost irresistible incentive for businesses across industries to tout AI as a significant source of future savings, efficiency gains, competitive advantage, even if the technology isn't quite there in terms of widespread, measurable job displacement yet.
So it sounds good to investors.
Exactly. We've actually seen a similar pattern in past economic shifts and downturns. For example, in 2023, when many companies announced job cuts, they often cited rising interest rates or uncertain macro conditions as the primary reasons. Today, the narrative has subtly shifted. Increasingly, the stated reason for layoffs is simply, it's AI. Roger Lee, a tech entrepreneur who meticulously tracks tech industry layoffs, highlights this trend. He notes that tech layoffs hit a 3-month high in July, with Intel, Microsoft, and Recruit Holdings, the parent company of Indeed and Glassdoor, largely responsible for those reductions. Now, while all three of these companies cited AI as playing a role in the job cuts, Lee points out that in some cases these claims were quite vague, lacking specific details. For instance, Recruit Holdings simply stated that AI was changing the world, offering no specifics on how it directly impacted lost positions or the number of roles specifically affected by AI implementation. Just a general statement. Right. This suggests that AI might sometimes be used as a convenient cover, perhaps, or a modern justification for cuts that are, in reality, driven by broader economic pressures, market consolidation, other operational factors. So while AI is certainly a factor in some corporate restructuring, it's also a powerful buzzword in corporate communications right now, potentially used to manage investor expectations and public perception.
So we're seeing genuinely mixed signals in the job data then, suggesting a far more nuanced picture than simple headlines imply. While the overall landscape suggests a lack of widespread AI-driven job losses so far, there are definite distinctions. For instance, data indicates that all job openings, entry-level or otherwise, have been declining since 2023. However, this trend hasn't been a linear across-the-board reduction, and there's a particular distinction that stands out. Revelio Labs, a labor market analytics company that really deep dives into job data, found something interesting. They found that entry-level jobs exposed to AI, meaning roles with tasks more readily automatable by current AI capabilities, have indeed been declining fastest.
That makes intuitive sense.
It does, right? AI might first automate more routine, foundational, or repetitive tasks. But here's the interesting twist, the counterintuitive part. Their data also shows that senior roles exposed to AI have actually begun to recover and even increase.
Really? Senior roles are increasing.
Apparently so. This suggests that while some jobs at the lower end of the skill spectrum might be impacted by AI, there might be new roles emerging or increased demand for higher-level positions that require managing AI, developing it, strategically interacting with AI systems. And when we look at broader white-collar professions, those most often cited as being at risk, like office administration, accounting, legal services base, the picture generally shows fairly stable employment trends. For example, the official jobs report from just last week indicated that office and administrative roles have actually returned to their pandemic-era highs.
That's surprising.
Isn't it? Similarly, employment in other professional sectors, like accounting and legal services, has held relatively steady, without the predicted mass layoffs. So while there's certainly some churn, particularly within the tech sector itself, a mass exodus from white-collar jobs due to AI hasn't been widely observed across the board in the general economy. The narrative is clearly more complex than a simple "AI is taking all our jobs" headline.
It's an incredibly complex picture, yeah. And it leads us directly to what economists often refer to as the productivity puzzle.
Yeah.
The simple, almost intuitive calculus behind AI suggests that businesses, by leveraging these powerful tools, should be able to do more with less. That is, increase their overall output and efficiency, thereby boosting productivity and reducing the need for new hires.
That's the theory anyway.
That's the theory. The idea is AI automates tasks, makes processes leaner, therefore fewer human hands are required to produce the same or even greater output. However, our sources indicate that economists are finding it, quote, difficult to calculate accurate changes in productivity over the short term, unquote. And perhaps even more counterintuitively, national measures so far have actually shown a deceleration in productivity in recent quarters, not the robust acceleration one might expect from a truly transformative technology like AI.
A deceleration, so less productive.
According to some national measures, yes. This suggests that the significant productivity gains we anticipate from AI aren't yet showing up in the aggregate economic data, raising questions about measurement, perhaps, or the true pace of integration. What's even more surprising, according to a forthcoming paper from researchers at Carnegie Mellon and Stanford University, is that most of the benefits of the current wave of generative AI are accruing to consumers, not businesses.
To us, not the companies.
Largely, yes. If it feels like much of the immediate value you're seeing from generative AI, for example, is primarily allowing ordinary people to generate emails faster or papers faster or do quicker research for personal projects, you're absolutely not imagining things. The authors, Avinash Collis and Eric Brynjolfsson, calculated that consumers derive the equivalent of a staggering $97 billion in surplus welfare from generative AI in 2024. Compare that to a mere $7 billion in revenues logged by the tech firms actually creating these AI products.
$97 billion versus $7 billion. Wow.
It indicates a fascinating disconnect. While AI is providing significant utility and value to individuals, much of that value isn't yet being monetized or translating into traditional business productivity metrics or corporate profits on a grand scale. Collins also points out that economies typically experience what's known as a J-curve effect when truly transformative technologies are introduced.
The J-curve. Remind us.
Okay, think about the shape of the letter J. When a truly disruptive technology like AI is introduced, there's often an initial period of disruption, or a slight dip. That's the bottom curve of the J. Why does this happen? Because industries have to retool. Existing infrastructure needs to adapt, workers need to retrain, established business models might struggle or even become obsolete, like Kodak with digital photos.
Right, the initial pain.
Exactly. But then, as the technology matures, new opportunities explode, entirely new industries emerge, many new jobs are created, leading to that sharp upward spike, the vertical part of the J representing massive growth and unforeseen benefits. He suggests that while there will likely be significant impact, potentially negative in some specific sectors or for certain types of workers, at the same time, lots of new jobs could be created as well in the long run. This long-term perspective suggests that initial disruptions, while real, may eventually lead to unforeseen new industries and roles we can't even imagine today.
That J-curve effect is a crucial concept. Reminds us that major technological shifts always play out over time, often in unpredictable ways. But right now, we're seeing vastly differing forecasts on where AI is taking the job market in the more immediate future. It's quite polarized. On the more pessimistic side, Dario Amodei, the CEO of the prominent AI firm Anthropic, has issued a stark warning. He foresees half of all entry-level white-collar jobs being wiped out in the next 1 to 5 years.
That's huge.
It is. which he says could spike unemployment to a startling between 10% and 20%. That's a truly dramatic and unsettling forecast, painting a picture of widespread societal upheaval. On the flip side, though, we have figures like Jensen Huang, the visionary co-founder and CEO of NVIDIA. He's considerably more optimistic. He believes AI will ultimately lead to more jobs overall, even if he acknowledges that some jobs will be unnecessary and some people will lose jobs. His core assertion, based on historical precedent of technological progress, is that the world will be more productive. His view is that the vast efficiency gains brought by AI will create new demand, new types of work, ultimately expand the economic pie, leading to a net increase in employment, albeit in different areas. The nuanced reality on the ground, however, suggests that while AI-related job cuts are accelerating, Challenger, Gray, and Christmas reported 20,000 cuts in 2025, specifically blamed on automation and AI implementation, plus another 10,000 directly attributable to AI.
Okay, so they are happening.
They are happening, yes. But these figures are still relatively small when compared to cuts due to broader economic conditions. Those broader cuts related to government spending declines, shifts in consumer demand, general economic conditions account for nearly 500,000 lost roles this year.
So AI cuts are still a fraction of the total.
A small fraction, exactly. While AI is certainly a factor in some layoffs, it's not yet the dominant driver of overall job reductions. Goldman Sachs analysts also chime in, noting that only about 9% of all companies across various sectors are regularly using new AI tools to produce goods or services. The significant detail suggests that AI's overall impact on the general labor market is pretty small so far, precisely because the actual widespread adoption and deep integration of these tools across the economy are still in their very early stages.
And this leads to an important and very timely caution from JP Morgan analysts. While their research for now has failed to find a significant impact on job growth, they issue a strong warning. This situation could change dramatically and very quickly. They specifically caution that large-scale displacement for occupations could occur during the next economic downturn.
The recession factor.
Yeah. Exactly. This is a critical point everyone needs to consider. If AI adoption speeds up, it almost certainly will in us, and we then enter a period of economic contraction. Businesses might be far more aggressive in leveraging AI to cut costs and reduce headcount, making it a primary strategy for survival, perhaps. For white-collar workers specifically, they predict that during the course of the next recession, the speed and the breadth of the adoption of the AI tools and applications in the workplace might induce large-scale displacement for occupations. This suggests that while AI's job impact hasn't been massive yet in a relatively stable economy, it could become a much more significant and acute factor during an economic downturn, as companies prioritize efficiency and cost-cutting more intensely than ever before. It underscores that the full labor market implications of AI are still unfolding and are likely to be heavily influenced by broader economic cycles and corporate strategic responses.
That's a sobering thought, the idea that a recession could accelerate what's currently a slow burn into a wildfire of job displacement. Okay, let's shift gears now from the theoretical discussions and broad statistics to a very concrete, high-profile example. An example of AI's real-world challenges, even for the most ambitious players. Tesla's in-house supercomputer project, Dojo. For years, we heard Elon Musk hype Dojo with incredible fervor, portraying it as this revolutionary internal supercomputer absolutely central to Tesla's future, its sole purpose, designed to train the incredibly complex machine learning models that power Tesla's autopilot and full self-driving software.
Right, the FSD training.
Exactly. He called Dojo a beast, suggesting it would give Tesla an insurmountable edge in autonomous driving technology, allowing them to process vast amounts of real-world driving data at speeds no one else could match. It was a massive, expensive ambition, positioned as absolutely central to the company's vision of becoming a leader in robotics and AI.
However, the current state of Dojo, according to recent detailed reports, suggests that it has, indeed, lost its mojo. Tesla is now reportedly shutting down Dojo.
Shutting it down completely.
That's what the reports indicate. A significant and somewhat surprising reversal for a project once so heavily touted as a cornerstone of their AI strategy. The head of the project is reportedly leaving the company, and perhaps even more tellingly, the entire team has been disbanded in its entirety.
Wow, disbanded, not just reassigned.
Disbanded. It sounds like a complete dissolution. Further compounding the issue, the team experienced a notable brain drain, losing around 20 workers to a competing data center firm that has been actively poaching former Tesla executives, specifically from their AI and supercomputing initiatives. This talent drain, our sources indicate, extends beyond Dojo itself, with key executives reportedly leaving Tesla more broadly, suggesting deeper challenges in retaining top AI talent. Even Elon Musk himself, who initially hyped Dojo so much, admitted last year that he'd come to think of Dojo as a long shot, acknowledging that it's not something that is a high probability. And more recently, he tweeted, quote, "It doesn't make sense for Tesla to divide its resources and scale two quite different AI chip designs," indicating a pragmatic strategic shift and a recognition of the immense, almost prohibitive challenges in this highly competitive, resource-intensive field of AI hardware development.
So it's clear Tesla is fundamentally pivoting its strategy here. Instead of relying solely on this massive bespoke in-house supercomputer for training its AI models, they are now looking to depend significantly more on external tech partners.
Like NVIDIA and others.
Exactly. We're talking about major established players like NVIDIA, AMD, and Samsung for manufacturing their crucial AI chips and providing the necessary infrastructure. For instance, there's even a widely reported $16.5 billion deal with Samsung for AI semiconductors.
So $16.5 billion, that's huge.
An absolutely massive commitment to external reliance. It's important to clarify, though, Tesla isn't giving up on all in-house chips. Their efforts are now being funneled into Tesla AI5, AI6, and subsequent chips, which Musk indicates will be excellent for inference and at least pretty good for training. So they're narrowing their internal chip focus while expanding their external partnerships for high-volume, high-power AI processing. But this shift raises a critical question for many observers. Given the immense resources, time, attention poured into Dojo, was this yet another massive distraction by Musk, diverting precious capital and engineering talent from other crucial areas, only to ultimately concede that external expertise and established hardware providers were the more viable path?
That's a very fair question, yeah. And the case study of Tesla's Dojo unraveling connects directly to broader implications for AI development across the entire industry. Tesla's struggles illustrate several key challenges. Firstly, it highlights the surging competition in the AI hardware and infrastructure space. Everyone from tech giants to specialized startups is vying for dominance. Secondly, it underscores the intense talent wars underway. Major tech companies are aggressively poaching key talent, often offering staffers at competing firms absurd sums of money to lure them away.
The bidding wars for AI talent.
Exactly.
Yeah.
This isn't just about salaries. It's about enticing the brightest minds with cutting-edge projects and resources. This highlights the immense resource demands, both financial and human, and the often unpredictable nature of large-scale AI development. Even for companies with the financial might and visionary leadership of Tesla, building truly cutting-edge AI infrastructure isn't just about technical prowess and ambitious vision. It's about navigating a fiercely competitive landscape for the brightest minds and the sheer capital required to sustain such endeavors. And the real-world consequences for Tesla, they're becoming increasingly apparent. Their self-driving efforts, which Dojo was explicitly meant to accelerate and perfect, have continued to be described as chaotic and underwhelming by critics and users alike. We've seen instances like the initial rollout of their robotaxi service in Austin, Texas, being plagued by technical issues and terrifying near misses, highlighting that the technology is far from mature. And more gravely, just last week, Tesla faced a significant legal setback. A Florida jury deemed them partially responsible for a fatal collision involving its autopilot software.
Oh, wow.
A decision that will force them to pay out nearly $250 million. This demonstrates that the challenges in achieving truly safe, fully autonomous driving are far more complex and legally fraught than perhaps initially anticipated. And the failure of ambitious internal projects like Dojo can have very tangible and very expensive consequences for a company's core products offerings, its regulatory standing, and its public trust.
Wow, what a deep dive indeed. We certainly spanned a lot of ground. From the speculative highs of AI stock valuations, examining that inherent tension between raw market excitement and the more grounded caution from Wall Street analysts. We've explored the granular, often unseen impacts of AI on our cognitive processes, our perception of truth. Considering how our increasing reliance on these tools might be subtly rewiring our brains and challenging our fundamental ability to discern fact from fiction. And we've looked at the nuanced, evolving reality of AI's effect on the job market, seeing that while fears are widespread, emotionally charged, the actual data presents a more complex and so far less apocalyptic picture than many predict. And finally, we zoomed in on Tesla's ambitious, yet ultimately derailed, Dojo project, which offers a powerful, real-world case study in the complex, immensely resource-intensive, often unpredictable challenges faced even by tech giants when trying to implement large-scale, transformative AI initiatives.
It truly reinforces the core message we wanted to convey today, I think. AI is not a monolith. It's not a single, easily defined entity. Instead, it's a dynamic, multifaceted force with profound implications across every sector of society: finance, labor, even our very minds. It's an undeniably powerful tool, certainly capable of incredible things, but its integration requires careful, deliberate consideration. This applies both for businesses deciding where to invest their substantial capital and strategizing their future workforce, and critically, for you as individuals navigating its impact on your daily lives, your personal skills, your professional trajectories. The promise of AI is immense, offering unprecedented convenience and efficiency. But so too are the responsibilities that come with wielding such transformative technology.
Absolutely. So as you go about your day, maybe interacting with the chatbot, seeing an AI-generated ad, I want to leave you with this provocative thought to perhaps chew on. Given AI's immense potential for convenience and efficiency and its growing capacity to offload human cognition, what is the optimal balance between leveraging AI's strengths and preserving our uniquely human skills? Critical thinking, discernment, creativity, nuanced judgment. How will you choose to integrate AI into your life to be smarter, happier, perhaps even richer, without letting it diminish the very qualities that make us uniquely human? Something to really think about.